So today we're going to take a look at some news that broke over the weekend, which was that 50-year mortgages were floated as an idea rather than your traditional 30-year fixed mortgage. So we're going to watch a little video from CNBC today and try and figure out some more news about it and see if there's any conclusions that we can walk away from it. I'm going to tell you right now, a 50-year instead of a 30-year sounds a little rough to me, considering the lifespan of most Americans and just most people in the world. We got about 70 to 80 years to be walking around this earth, and 50 years, so I got to buy a house when I'm 20, and then I'll pay it off when I'm 70. If I buy a house at 30, I'm paying it off by 80. I'm pretty cooked by 80. But, hey, we'll give it a chance, and let's see what can be heard about it.
Welcome back. So, could a 50-year mortgage option be on the horizon? The Trump administration raising the prospect of such a loan over the weekend. Our Diana Olick joins us now with the story. Diana, so how would this work?
Well, so Sarah, in an attempt to make home buying more affordable, President Trump floated the idea of a 50-year mortgage in social media posts. In response, FHFA Director Bill Pulte, who oversees Fannie Mae and Freddie Mac, posted that they are, quote, working on it and that it would be, quote, a complete game changer.
Okay, so the first thing is that, hey, if we're talking about that we're floating this for affordability and that it's going to be a game changer, then, hey man, I got to know that I'm saving a bunch of money. That's how you change the game for me, if I'm saving a bunch of money. If I'm not saving a bunch of money, then I don't know what this is going to be able to accomplish, what it's really going to be able to help. But hey, that's why you don't cut people off mid-sentence. Let me be quiet. Let me listen. I'll jump in when I need to. But, okay, we're calling this a game changer. Let's see how much it actually does.
Now, the purpose of a longer-term mortgage would be to lower the monthly payment for homeowners. The longer the term of the loan, the smaller the principal needed each month to pay it off in full. Now, using the latest median sale price of a home from September, that's $415,200 according to the realtors, and the current interest rate of about 6.3% according to Mortgage News Daily, on a 30-year fixed loan with a 20% down payment, the monthly payment of just principal and interest would be $2,056. If you raise the length to 50 years at the same interest rate, that payment would be $1,823, and that's a savings of $233 per month. Homeowners, however, would not build equity as quickly because their principal payments would be smaller.
All right, so already right here, going from a 30-year to a 50-year, you're saving $233. Now, $233 over the course of a year, 12 times 2, that's about 24, the 33. Let's just say you're saving, $3,000 a year. Is that worth it when you're paying off a loan for an extra 20 years? Math is looking a little rough already. So not only do I have to worry about my lifespan, but now I'm worried about if I'm really saving that much money. I mean, $3,000 a year is a big amount, but $3,000 a year versus 20 years of your life. Okay.
Amount of interest paid to lenders would be 40% higher.
Woo.
Now, the real question, though, is can Fannie and Freddie do this? Analysts say it is possible, but a 50-year mortgage does not currently meet the definition of a qualified mortgage under the Dodd-Frank Act, which provides investors with a backup from Fannie and Freddie if the loan should go bad. But regulators were given the authority to change that in order to ensure mortgage affordability. That, however, could take up to a year, according to Jarrett Seberg of TD Cowen. Seberg notes that we still just really need more housing because without more, home prices will continue to be inflated no matter what the mortgage rate is. Guys, back to you.
Yeah, which comes back to some of his other, efforts to try to put pressure the home builders to build more. So do we have any idea, Diana, what the rate would be for a 50-year mortgage, for instance, compared to a 30-year?
That is an excellent question because mortgage rates really depend on demand from the investors in the product. But what I can tell you is that the average rate currently on the 15-year fixed loan that is a shorter term loan, is actually 66 basis points lower than the 30-year fix, which would imply that a 50-year mortgage would carry a larger interest rate in order for investors to be able to get the money they need. But that's the question going forward. Would it really be cheaper, and would that math that I just did on that monthly payment actually be that if the mortgage rate was higher? It would not be.
Oh man, this is sounding rough. So not only, and look, she was looking at just the rate if it stayed 6%. And now, because a 15-year is lower interest rate than a 30-year, then that means that a 50-year would be higher than a 30-year, which means that, okay, so your payment may not even make a difference, and you've tacked on 20 more years to this loan. This all around looks like it's not really the greatest idea. And you know, that's the thing that I talk about on this channel, is that what is the solution so that you yourself can be someone who kind of avoids all of this, so that this is not that big of a concern? Because really the 50-year mortgages are an idea because people cannot afford housing right now. And while a lot of that has to do with outside factors, there's a couple of things that people can control themselves. It's hard, it takes a lot of discipline, but it helps. And that is the three things I always highlight: getting out of credit card debt, building an emergency fund, and simplifying your life. Now you say, Richard, how can getting out of credit card debt help me with this 50-year versus 30-year mortgage? It helps because you're not in a position to where you feel like you have to take a deal like a 50-year mortgage. If you are out of credit card debt and then the money that you have coming in from your job is being used towards an emergency fund and then building up your savings so that you can make a nice down payment, then you won't have to consider something like a 50-year mortgage. So it all goes back to personal habits, the things that you can control. Now, you can't control how the job market is, you can't control how the overall economy is, but your personal actions you can control. And so, especially when you start digging into a detail like this, where it's like, okay, boom, somebody here's 50 years, yeah, that'll be a lower payment, yeah, that's a better deal. Well, not when you really look into it. And that's what makes things like this really, really difficult to accept when you're studying them and seeing what they do to you in the long term. Let's let her finish up.
Yeah, none of it would make any sense then, if that was the case.
Correct. I mean, what really is, some people are saying that a 50-year fix is kind of like an interest-only mortgage because you're paying so much more interest than you're actually paying equity. And the fact is that most people don't keep their home for 30 years even. Would they keep it for 50? Most likely not. So the average rate of a person owning a home is actually longer than it's been in a long time because people aren't selling right now because they've got these locked-in low rates. So really, it's a question of, would buyers be interested in something like this if they're really not building any home equity?
Right. You're really not amortizing any of the principal, or not much of it.
Okay, so that's just rough to look at and think, because then you start asking yourself, okay, well, then what could be a help? What could be a solution? Well, a lot of that is out of our control. And that's why the solution is, well, what can you control yourself? Because maybe it's not the best to own a home. Maybe it's best to rent. I mean, these are questions that you need to ask yourself, but really getting your finances together and doing all that you can do is a great first step, because then you may be in the position where you don't even have to consider a 50-year. And you know, this was interesting. I did just a couple of numbers myself. I went to the trusty Chat GPT machine, and I wanted you all to take a look at this. This is what will happen if, you know, you were to compare a 30-year versus a 50-year. I put in a $400,000 house at 6% interest. So 30-year at 6%, your monthly payment is $2,398. Total paid over the loan, $863,353. You're paying interest. The interest that you pay let me blow this up a little bit. The interest that you would pay is $463,000, 353. Okay. And then your equity, as in what you basically get back, the worth of your home over 10 years is $73,000. Now look at this compared to the 50-year. 50-year, yeah, you get a lower payment. Instead of 23, you go down to just $2,059. But goodness gracious, the total paid over the loan, you're paying over $1 million. The interest is it's double this, $835,000, and then after 10 years, you only have $24,000 of equity. So the 50-year fixed rate mortgage, it may sound real good when you initially hear it, but when you break down these numbers, this is not a solution that seems like it's going to work. And now many people will say, well, hey, the solution could just be raise wages and make the dollar stronger and bring the cost of things down. Yeah, that makes sense, but is that in your control? That's the key. You know, what is in your control? And what's in your control is just making sure that you can be as financially responsible as you can be. Now, when it comes to this job market, that's the hardest part, making sure that you have a job and making sure that you have a job that actually pays you. I'm not talking about getting a job that's, a gig worker or, DoorDash, Instacart. I'm talking about getting a job that is paying you a livable wage, which really is like 70 to 75,000. But it has to be a job that works with your schedule, allows you to be with your family, allows you to have time in your life. But, when you get that job, you need to know what to do. See, here's the thing, and I'll end the video with this. A lot of the people who are struggling financially are struggling for things or because of things that are not in their control. But there are some that are struggling, and yet the circumstances are in their control. As in this, if you're overspending, you're eating out, you're buying up all the latest and greatest tech, you're just not saving anything, you're not taking your expenses seriously, you're doom spending. Well, man, when situations like this come up, when the economy goes bad like this, it becomes very, very hard. But if you're a person who does have a job right now, who does have an income, it will help to pull back. It will help to simplify your life. It will help because times like this are going to happen. They are going to happen. You have the benefit of preparing. So, I'm going to say this, as I always say in all my videos. Hey, get out of credit card debt. Build a 6 to 12 month emergency fund and simplify your life. I'm telling you, I did it and it's paying off for me. And I'm hoping that I can continue to save as long as I can for times like these. So I tell you what, before I end this video, why don't you comment below? Tell me what you think. Tell me what you think about a 50-year fixed rate mortgage. Because I think it's a bad idea, but maybe you think it's a good idea. Tell me what you think. But until then, y'all, I'm going to get on out of here. Y'all have a good day. I'll talk to you later.